Hello, it's a lovely good evening from here in Delhi, and hope each one of you, as always, are absolutely fine, hale, and hearty. So, now we have decided to start a very significant, prominent, and a formidable chapter. In fact, extended, you can say, that is IFRS 10. And in the Indian context, you can say we are starting India's 110. As each one of you are very well aware of this particular fact that India's 110 or IFRS 10 actually deals with preparation of the consolidated financial statements. But the good thing about this particular standard is that before we delve into the intricacies of this accounting standard, good thing about this standard is that it is very much a part of what we call international syllabus. So whether you happen to be from India or from any other nation, if you are following these lectures, I can assure you that you are going to drive. We on our part can say definitely some benefits out of it. So whether you happen to be residing in India or for that distance in Bangladesh or Nepal or for that distance in Pakistan or Sri Lanka or in any other nation, and you are preparing for the professional body examination, even the students who are preparing for ACCA or for any foreign level, as I said, what we call professional level examinations. So these series of lectures will be highly, I'm very sure, not only delightful, but quite what we call satisfying for you. So keep an eye over this particular series, that's all I can say. And so now we come directly to the business end to start this particular chapter. This particular standard, you can say, that is IFRS 10, as I said, or India's, in the Indian context, we call it India's 110, but it is absolutely on similar lines of IFRS 10, hardly any difference. So even as I said just a moment ago, whether you happen to be in India or outside India, whether you are preparing for what we call professional body examinations of India or for your nation, you should be in a position to derive some benefit out of these series. So here we go and start this particular interesting standard. As I have already told you, it's pretty formidable, it's significant, and it constitutes a very significant part of the syllabus. So whichever body examinations you are preparing for, I'm very sure questions from this particular standard obviously will be part of your examinations. So here we go now and start the session. So I've already written, as you can see in your screens actually, India's 110. In the Indian context, IFRS 10 is known as India's 110, correct? It deals with consolidated financial statements. So, and you have heard about consolidated financial statement, I am very sure. So first of all, we'll pick up the threads right from the scratches, and slowly and steadily we'll move over to the higher notches. So what exactly is the theme of India's 110? First of all, we would like to actually discuss the same. India's 110 actually provides the basic objective, to be very honest with you. It provides some guidelines with respect to the preparation of the consolidated financial statement. That is one part of the entire guidelines or the spectrum of the guidelines which this particular standard actually provides us. We will discuss one by one all those guidelines. Initially, this particular work which I am going to do before you, it's a sort of rough work. Whether you are interested in writing, it is entirely up to you, but later on we will definitely write each and every point, correct? So now we come over to the point. As I said, first of all, we need to know the objective of this particular standard. So what's the objective of this particular standard? Just a moment ago, I said the main objective of this particular standard is that if you happen to be a parent and you are in control of one subsidiary or more than one subsidiary, then as per the guidelines of this particular standard, you are supposed to actually prepare the consolidated financial statement. That happens to be the first guideline. So first guideline, even I am writing, and of course I am going to explain it. So first guideline of this particular standard states that every parent having subsidiaries subsidiary or subsidiaries. You may have one subsidiary, you may have more than one. Have subsidiary or subsidiaries is supposed to prepare Supposed to prepare what? Supposed to prepare what? Consolidated financial statement. I will write in short form. Don't confuse it with cash flow statement. It is consolidated financial statement. In the entire chapter, CFS shall stand for consolidated financial statement, as I said a moment ago. What does this particular line actually leads us to? Just have a look down over here. Suppose there is an entity by the name of E1, correct? And there is another entity by the name of S1. This entity holds, let us say, 70% stakes of this particular entity. Indirectly, it means, suppose if total share capital of S1 happens to be 10 lakhs, correct? Then out of 10 lakhs, 70% is in the hands of E1. In accounting terminology, or in IFRS terminology, we may say that, where is my scale actually? Just hold on for a while. Right. So in accounting terminology, we may say this company is an investor because we have invested. E1 is investor. We are starting right from the scratches. Remember one thing, even I know that each one of you are very well aware of what exactly E1 is. And S1, of course, will be termed as investee company. Sometimes student fraternity confuses over these two terms, so I would like to actually clear it right at the initial stage. This is known as investee. S1 will be known as investee. E1 is the investor, quite obviously. Obviously, when we invest somewhere, we expect to have some returns out of our investment. That is the reason actually why we invest. But sometimes we invest very heavily, and that gives us some sort of control. Supposing for a while that E1, as I said, is having a 70% stakes, and this 70% stake is quite heavy, so we are presuming for a while that we are controlling this particular company. Remember one thing, under IFRS, whenever I would say IFRS, please actually connote it with Ind AS 110, correct? Because we are taking this class not only for the in the Indian context, we are taking it for the international context, correct? So instead of using Ind AS 110, most of the time actually I will use the term IFRS 10, correct? So that a student of any nation actually who are watching these lectures need not have any sort of what we call trouble in comprehending the things. So E1 happens to be the investor, and it invests in S1. 70% stakes are in the pocket of E1. It is quite a big stake. Out of what we call 100%, 70% is in our pocket. So quite obviously, we are having a big influence over this particular company. Presuming for a while that we are having the control also, because control is entirely a different term. We will talk about it later on, correct? Howsoever big or huge your investment might be, but that doesn't mean that it is a conclusive proof of the fact that you are having the control. But we are presuming that we are having the control of this particular entity, correct? So in accounting parlance, this entity, as each one of us are very well familiar with the fact, will be known as subsidiary and investor. An investor will be known as each one of us knows, parent. So E1 happens to be parent and S1 happens to be a subsidiary. Now just allow me to stress this particular example to some further limits. Presuming further, I've already told you E1 has invested in 70% what we call stakes of S1. Now we presume that S1 has invested 70 or say let us say 60% in S2. There is another company in the market. Out of its total share capital, 60% is in the hands of the S1. Again, 60% happens to be quite a big stake. We presume for a while that S1 is having a control because I told you, under IFRS, more than 50% investment is not a conclusive proof of the fact that we are exercising the control, because control has some other elements too, regarding which we are going to have discussion at length, of course, but quite later on, correct? So right now, we are simplifying the things and trying to understand the meanings of what we call these terms, correct? E1 has invested in 70% share capital of S1. At the same time, S1 has invested in 60% share capital of S2. So quite obviously, now what happens when we will analyze the relationship between now S1 and S2? Could you let me know actually what S2 would be termed? Quite obviously, S2 will become subsidiary of S1. It will become, I will write subsi, okay? Because subsidiary is quite a big term to write every time. So S2 is subsidiary company of S1. That means S1 is parent of S2. S1 is parent of S2. But S1 is under our control. So if S1 is under our control, it indirectly leads us to the fact that S2 is also under control. We may say in accounting terminology that S1 is exercising direct control over S1, whereas E1 is exercising indirect control over what we call S2. This is indirect because this control is being exercised by E1 through its subsidiary. Further in accounting terminology, if we will take or analyze the relationship among all these three entities, we may say E1 is the parent, S1 is the immediate subsidiary, and S2 is the ultimate subsidiary of E1. Ultimate, that is final, correct? So this is the relationship among what we call all three entities. So the first point is that if a parent is having a subsidiary or more than one subsidiary, and parent is exercising, of course, the control, logically speaking, control can be exercised, then only other entity can become our subsidiaries. So when I say subsidiary, logically it means E1 is exercising the control. So if any entity is having subsidiary, one subsidiary or more than one subsidiary, it is bound to prepare the consolidated financial statement. Of course, we'll talk about some exceptions. As we know, under standard, there are always some exceptions. We'll talk about those, but later on. So this is the first statement regarding what we call objective. What is the next one? Now suppose for a while, it is established that a particular entity has a control of other entity. Now let us say that fact has been established, that a particular entity has a control of other entity. If this particular fact has been established, so quite obviously, then consolidated financial statement will have to be prepared. But how those consolidated statements will be prepared, of course, this is yet another objective of this particular standard. That means this standard actually will give us some guidelines, some clues, some what we call, you can say, ideas to prepare the consolidated financial statement. So that is the second objective, principles regarding preparation of consolidated financial statements. Principles regarding preparation of consolidated financial statements. Preparation of consolidated financial statements, correct? Further, this standard, as I said, provides us some guidelines with respect to what are these principles of preparation of the consolidated financial statement. To be very honest with you, it is nothing but it is accounting. Now, accounting part we are, of course, going to take later on. Right now, actually, we are trying to just take a bird's eye view of the entire what we call provisions of this particular standard. See, I was telling that third objective, you can say, or the third guidelines actually deals with respect to principles of control. That is very, very significant. Principles of control. It looks very easier. It looks like a cup of coffee, but it is not. Principles of control. Remember one thing, unless and until an entity would exercise control of the other entity, control is a very big word and we will have to control it. So unless and until an entity would exercise control over the other entity, we cannot what we call apply Ind AS 110 or IFRS 10 as we say. We need to know whether an entity exercises control or not. So what this exactly control word is, remember one thing, just a moment ago when I started this particular standard, I did tell at that time also that just our investment stake or the size is not the conclusive proof There was a time earlier when we used to say that if we are having more than 50% stakes in the other entity, we are exercising the control or we are in the control of the things. But those days are now over. We have to follow the guidelines of IFRS. There are some other evidences where an entity, in spite of the fact that not having more than 50% stakes, but still it is in the control of the other entity. So what exactly the control first word is, let me actually explain it too. If we want to know whether we are exercising the control or not, we need to look over these facts. See here, I will use red pens if you allow me to for a while, correct? Principles of control. I just a moment ago, I also said when I invest in an entity, or for that instance, when you invest your hard-earned money into some entity, what's the objective behind that? When you invest, you let me know very honestly, when you invest your hard-earned money, correct? Today you receive the salary and tomorrow you invest that amount. Why you are investing? In the hope of earning something out of it. What sort of return it would fetch to you? Obviously, you know better than I actually in this case that you are expecting to have some dividend or you are expecting to have some interest. If you are investing in shares, of course you're bound to get what we call dividend. At least you are hoping for to have some dividend, and if you are investing in bonds or debentures, correct, or other interest-bearing securities, then you are going to have a hope of having interest. That means all in all, when we invest our money, two things are involved here, just pay attention. One, when I invest into the stakes or stocks or share capital, whatever word you may like to, because in different nations we use different words, to be very honest with you, that is why I am using all three. When I invest in the share capital of an entity, I hope to have dividend, but it is just a hope. I might get dividend, I might not get dividend, or I might get dividend regularly or irregularly, or I might get dividend of an amount which is much lower than my expectation or might be higher than my expectations. It means when we invest, we are exposing ourselves. See, remember what? Many a times I have seen actually student fraternity are actually, let me actually come over to this particular slide first, then you will be able to have a look over me now. Sometime it becomes very important to actually go through the actions so the intensity of the wordings can be grabbed quite easily. What my point is, suppose I'm investing my hard-earned money. Now if I'm investing my hard-earned money, obviously I said I'm exposing myself. Exposing in the sense, I have seen, I was talking about this particular fact that students sometimes actually misconstrue these words. Expose means it is in negative sense. That means you are taking a risk here. That is why word exposed is being written over here. So when you are investing, two things are happening concurrently. One is that you are exposing yourself to the risk that you might be having the return, you might not having the return. In fact, you are exposing yourself. When we are using the word expose, it means you might not have the return, because expose word is used in a negative sense. On the contrary, when I invest, then investing company, we presume for a while, is able to earn a very heavy profits. Investing company is the company wherein you have made the investment. Remember one thing. Now what happens? If the investing company has earned heavy profits, obviously in this case you are bound to have high returns. It means because your investment is there, it is providing you a right over the higher earnings of the investee. Are you getting my point or not? Our investment does two what we call simultaneous acts. One, it exposes ourselves to the risk. At the same time, it provides us the right to the returns. So returns can be variable. And when we say variable in negative sense, it means actually we are exposing to that. And when we say variable in the positive sense, higher return, I mean to say, that means we are having a right over it. What control is tended, now I come to this slide. So I was talking about the principle of the control. An entity is said to be in control of the other entity when entity when entity exposes itself to the variable returns. Here, variable stands for no return or lower returns, because word expose is there. Entity is exposing because there is always the possibility that we might not have the return, or we might have a return which is much lower than our expectations. Correct? So entity is exposing itself to the variable returns. Second, entity is having a right over variable return. Here you have to construe the word variable in a positive sense, means higher return. Entity is having a right over variable return. All in all, it means whatever returns are there, you will have definitely share in it. If shares are lower, we may say you are exposing yourself to that. If your share is higher, it may be said that you are having a right in it. Is it clear to you? Entity is having a right over variable returns. But point here is that entity is exposing, or entity is having a right. How this exposement, if you allow me to frame the word, how this exposement and right will flow to the entity because of its involvement in the investee. And how the involvement has taken place because of the fact that we have invested some amount in the investee. That means these two things arise because of involvement in investee. Because of involvement in investee. Investee is the company or entity wherein you have invested. Involvement in the investee due to investments, because you have invested some amount over there. Is it clear to you? Principles of control. An entity is said to be in control of the other entity when 1, 2, and 3rd. Entity has the ability to influence the returns on account of power. This is very significant line. When all these three things will be present, then only we may say that in view of IFRS 10, an entity is in control of the other entity. Try to understand this particular point, the third one. First two is quite obvious. We have made the investment, we are exposing or earning a right to the variable returns due to our involvement. Now, third point is that, to be very honest with you, control will be established only when the third point will be present. You have the ability to influence the return on account of power. You must have the power and the ability. In fact, this ability will come to you only due to power. You have the ability to influence the returns of the investee company. It can happen only when you are in a position to dictate the terms, when you are in control of all the relevant activities of that particular entity. But problem is that it is not so easy. When we invest in a particular company, do we acquire the what we call power enough to influence the activity of that particular company? No. Remember one thing, you must have the ability to direct the relevant activities of the other entity. So third line, what does it mean? Let me explain it this way. Has the ability to influence the returns on account of power. It means somewhere I need to know the meaning of power also. Then only I will be in a better position to explain, isn't it or not? See here. Generally, it is said that we have power. Generally, it is said we have power when how power can accrue. It is very important. Generally, it is concluded that if an entity, say there is an entity P and there is an entity S, generally it is inferred that power accrues to an entity on account of its heavy investment. Say I have invested in 80% share capital of this company. Obviously 80% is not a meager amount, isn't it? It's quite a heavy investment. If I'm having 80% shares, quite obviously, one may think and tempt to think, in fact, that I'm exercising the control. Of course, this is something which gives us a clue that whether we are in control of the other entity or not. Correct? This is one way to actually see the fact that whether we have got the control or not. That means your investment is stakes. It is not a conclusive proof, but it definitely gives you a clue. Let us say there is another case. Suppose there is an entity P and there is an entity S1. Let us say this entity P1 has invested in 40% stakes. In 40% stakes. Further, there is an arrangement. There is an arrangement between this company and this one that you will have the right, there is a specific arrangement, say, that you will be in charge of all the relevant activity, directing the relevant activities. Suppose if there is a specific agreement between these two, what we call entities, that you are going to direct all the operational activities, all the financial activities, all the relevant activities of S1, quite obviously, this leads us to the fact that in spite of the fact that we are having only 40% stakes, of course 40% stakes is also quite a big stake, remember one thing, but there is a specific agreement also that we are going to direct the operational activity and the financial activities of S1. That means we are having the power in this case. Now take the third case also. In the third case, I am P2. Let us say there is an entity by the name of P2 and it has invested in S2. Now their investment this time is only 20%. 20% stakes will not give us enough power, to be very honest with you, but it definitely will give us some, what we call, you can say, reins to influence the decision making of S2. If somebody would ask me whether this time can you conclude that P2 is what we call in control of S2, quite obviously my answer will be a big no, because we are having only 20% stakes in S2. It is definitely less than 50%. But suppose there is a specific agreement once again. Now the specific agreement is that P2 will be entirely in charge of composition of board of director of S2. It will be the prerogative of P2 only to compose the board of directors of S2. Now, if it is my prerogative to compose the board of directors of S2, what does it mean? It means I'm in full-fledged control. So what my point is that IFRS simply is not concerned with the stakes. It takes into account many other facets. Mere fact that you are having more than 50% definitely is a clue, but not conclusive proof. For example, suppose I am given in the question that I have invested in 60% and no more further information is given. In that case, I will have to conclude that I am in control of the other entity. But suppose if the question states that I have got more than 60% share in another entity, but at the same time I do not have any right to actually participate in their operational and what we call other activities, in that case it will be concluded that I am not in control of the other entity. Are you getting my point or not? That means you must have the power to influence the activities, but what sort of activities? Standard says that you should have the power to influence. You should have the power to influence what? Relevant activities. Then only it will be considered that you are in the control. Relevant activities. This term relevant activities itself unfolds its meaning. Do I need to actually express it? Relevant itself means significant activity, activities which is the crux of the earnings. For example, there is an entity, I am talking about the investee entity. Investee entity is the entity wherein I have invested. I will come to this slide because I am explaining something. Now, investee activity is the entity wherein I have invested. Now, let us say investing company is engaged in the what we call, let us say, toll plazas. You know the toll plazas, you know very well, correct? When we cross over from one state to other state, actually there are toll plazas and we have to churn out what we call amount. There are lots of toll plaza and where I get very distracted due to this. But anyways, point here is that suppose the investee company is engaged in toll plaza operations. They have got lots of toll plaza and I have invested in that company. Then what will be the significant relevant activity of that entity? Obviously the collection of tolls, because this will be the greatest source of revenue for that particular company. So if I am in control of that activity, it will be constituted, it will be concluded, it will be inferred that I am in control of that particular entity. Is it clear to you or not? I hope so. So now at least you should get an idea. Mere fact that you are having so many shares of that particular company is not enough proof in the eyes of what we call IFRS 10 or Ind AS 110. We need some other facets. However, when we would solve the questions, for example, there are lengthy questions, there will be conceptual based questions, there may be lengthy questions, there may be case study questions. In the case study question, obviously, which will deal with only assessment of control or power or something like that, we have made a separate section wherein we are going to discuss near about 20 questions, correct? Obviously, in those questions, you will have much more information. But in questions where you are supposed to prepare only consolidated financial statement, in such questions, you will be given generally the stakes. No further informations will be given. So, when no further informations are given, then it becomes easier to know whether we are exercising the control or not. So, fact of the matter is that we were discussing these facts, the objectives. The first objective that if you happen to be an entity who is having subsidiary or more than one subsidiaries, you are supposed to prepare the consolidated financial statement. Besides, I said actually the second objective is with respect to the guidelines which is given by this particular standard to prepare the consolidated financial statement, and that is nothing in fact, that those guidelines is simply what we call accounting patterns, how to prepare the consolidated financial statement. We will have a look over those later on, as I said. Then we were talking about the principles of control. This happens to be the most important, significant facet. As far as principles of control is concerned, it is very important to understand that an entity is supposed to have control only when it exposes itself and earns a right because of its what we call investment in the other entity. We call it investee entity. Further, when we have the ability to direct its relevant activities, influence its what we call relevant activities. How? Because of the fact that we are having the power. And how the power comes, these are the explanations which I was trying to deliver to you. So power may come to you on account of what we call your investment, may on account of some what we call arrangement, may on account of the fact that you are in charge of the relevant activities. So these are the facets which we have to take into account before we establish the fact whether we are having control or not. Is it clear to you or not? Then after having a look over all these things, so these are the major what we call, you can say, objectives of this particular standard. Correct? So once you have become deft, you need to know, sometime we will use the word group. When I would say group, what does it would mean? Let me write here 1. I do not want to leave nothing to chance. Correct? So group, whenever I would say group, it means I am referring to parent and subsidiary. If I would say group, it means group constitutes parent and subsidiary. Parent plus subsidiary. All the subsidiary. I am writing subsi means subsidiaries. Correct? Of course, if suppose I would ask you what do you mean by subsi, you should be in a position to deliver the answer. It is an entity which is controlled by other entities. Suppose this is S1, this is P1, and S1 is controlled by P1, then S1 is subsidiary company of P1, as we have already discussed all these things. Logically, if you happen to be a parent company, you are supposed to prepare consolidated financial statement without an iota of doubt. Correct? However, as I said in the initial stages, and being a professional level student, that too of IFRS, correct, you need to know that which are the exceptions. Sometimes I have seen that the student fraternity skips this point, so you need to actually take those into account too. That is the fourth one, exceptions. What are the exceptions? Let me pick the red pen. Exceptions. We have seen and we have gone through right from our earlier phases of education, whenever we go through the what we call standard part, there are always exceptions, isn't it or not? And generally we go through the entire feed of what we call standard and leave that part. But anyway, just for the knowledge sake, you need to understand this very important facet, because when tomorrow you are going to enter into what we call interview sessions, you are going to be tossed of such questions which you mostly neglect. I have seen through my experience myself. So just actually pay down some attention over here. I'm sure these are very important facets which you will like. Exceptions. As I said just a moment ago, logically, every parent is supposed to prepare consolidated financial statement. But suppose if you are a parent, now pay attention, because you will if I will go through the entire sentence, you will not be able to comprehend the same. So I will try to explain it this way. Just pay attention. Suppose there is an entity P, and I will use the red pen this time to write P. Correct? There is an entity by the name of P. We further presume that it is in control of this entity S1. Okay, S. Quite obviously, this is a parent company. If we take into account the relationship between these two, we may conclude that P happens to be the parent company, quite obviously, isn't it or not? Yes, sir. Thanks. This is parent company, this is subsidiary company. Now we further presume there is another entity, let us say Q Limited or Q Incorporation. Whatever you may like to, whatever in your nations, you use the term limited, incorporation, establishment, whatever, correct? We in India use limited. So Q Limited, let us say, is a company. And P Limited, let us say Q Limited has invested in P Limited. Remember, P Limited has invested, let us say 70% in S1. And S1, I have already told you, is subsidiary of P. We are presuming P is having control. Whether I would say control or whether I would say that P is having control or not, you always presume, because no further information is given. We are given only this, that P has invested in 70%. We are presuming P is having what we call control on account of what we call its majority stake. Now, Q Limited too, in this particular case, has invested, let us say, 55% in total stakes of P Limited. It means if we are going to analyze the relationship between Q and P, we find that this particular company now is a partially owned subsidiary of Q Limited. P Limited will become partially owned subsidiary of Q Limited. Q Limited has invested in 55% stakes of P Limited. Suppose Q Limited had invested 100%. Suppose 100% of the share capital is in the hands of Q Limited, then I would have said that P Limited is wholly owned subsidiary. Wholly owned subsidiary. Then I would have said that P Limited is wholly owned subsidiary. Isn't it or not? Of Q Limited. So this time, this parent, of course it is a parent of S1, but this P Limited also happens to be subsidiary of Q Limited. Standard says that if parent happens to be a partially owned subsidiary or a wholly owned subsidiary, and this parent P, this sheet is over, I am moving over to this part, correct? And suppose P Limited decides not to prepare CFS. Now you may tempt to say, sir, just a moment ago you said actually that if you happen to be a parent, you are supposed to prepare CFS. Remember, and don't let it skip out of your memory, actually we are now concentrating on the exception part. So if you are a parent, besides that you happen to be a subsidiary, whether wholly owned or partially owned of other entity. So P is a parent, but at the same time P happens to be a subsidiary company, whether wholly owned or partially owned. And P Limited decides not to prepare cash flow statement. And, where is my scale? And owners of P Limited, owners means shareholders, stakeholders, owners, whatever you may like to use the term, and owners of P Limited, decides that we have no objection. P Limited has resolved and decided, in fact, that we are not going to prepare CFS. And the owners of P Limited, whether they have got voting rights or not, irrespective of that, they have no objection to that. If owners of P Limited have no objection, correct? P Limited is having no objection. It's a pretty lengthy word. I told you if I am going to read the word in one sentence, then you would not have comprehended the same. It is still continuing. Don't let it skip out of this particular fact that we are talking about parent. This parent is having a subsidiary and this parent itself is a subsidiary of Q Limited. So if a parent who happens to be a subsidiary wholly owned or partially owned and decides not to prepare CFS, and further the owners of parent, whether they are having voting rights or not, they do not object to that. And see here, and it is not only one condition, there is another condition. And this parent company P Limited, this parent P Limited, its debt securities, debt and other instruments, debt and equity instruments, debt and other instruments are not publicly traded, are not publicly traded. Publicly traded, that means no trading is being done of debt securities and equity securities of this particular entity. Traded. And remember one thing, all these conditions must be satisfied, then only it will become an exception. We are moving right from the beginning now. Exception says that if you are a parent, but at the same time you are subsidiary wholly owned or partially owned, and you decide not to prepare the consolidated financial statement, and owners of your company, shareholders, it means whether they are having voting rights or not, irrespective of that, they have no objection to it. And further, neither your debt securities nor what we call your other instruments, including equity instruments, are publicly traded. And one of your subsidiary, whether intermediate subsidiary or ultimate subsidiary, just a moment ago I explained intermediate subsidiary. You are parent P, you are having a subsidiary this time, intermediate. Whether your intermediate subsidiary or ultimate subsidiary releases financial statements for public use as per Ind AS 110, then only you will be escaped of preparing from consolidated financial statements. So there is one more condition, then only it will become an exception. It means sentence is P Limited is a parent limited, number one. It is also a subsidiary wholly or partially. It decides not to prepare what we call consolidated financial statement. Owners of P Limited have no objection to it. Further, debt securities or for that instance, equity securities are not being traded in the public market, correct? Whether domestic or foreign. Remember one thing. And it means P Limited's immediate or ultimate subsidiary. Now in this case, the example which we have taken, we have got only immediate subsidiary, correct? So its immediate subsidiary or ultimate subsidiary prepares financial statements, FS, prepares financial statement. You can write the full sentence, prepare financial statement for public use. And those financial statements have been prepared in the light of Ind AS 110. Those financial statements have been prepared as per the provisions of Ind AS 10 or IFRS 10, because class is also for international students. Then it will become an exception. Is it clear to you or not? This is the first exception we talked about. Correct? The first exception is pretty lengthier. You must have seen. Now you will be able to grasp it. I'm very sure about that. So if you happen to be a parent, but at the same time you happen to be a subsidiary of some other entity, whether wholly owned or subsidiary owned, and you decide not to prepare consolidated financial statement, but at the same time your shareholders, whether having voting rights or no voting rights, have no objection to it, and neither your debt or equity securities are being traded publicly, whether in domestic market or foreign market, but one of your subsidiary, intermediate or ultimate, prepares the financial statement as per the provisions of Ind AS 110, and which are of course available for public use, then P Limited can be escaped of this particular fact that they are supposed to prepare consolidated financial statement. In that case, P Limited need not require to prepare consolidated financial statement. This is the first exception. Besides, there is another major what we call exception. That is, if an entity happens to be, if an entity, of course it is a parent entity, if an entity happens to be an investment entity, happens to be an investment entity, an investment entity, an investment entity. So if an entity happens to be, if you happen to be a parent company, but you are an investment entity. What we mean by an investment entity? Investment entity is an entity which has actually procured the funds from different investors. But the purpose is to invest those funds only in securities for the purpose of what we call earning returns or for the purpose of capital appreciation. Then you happen to be an investment entity. In that particular case, you need not require to actually prepare consolidated financial statement. Remember one thing. Regarding investment entities, we are going to have a separate discussion later on. But right now, my purpose is to give you a bird's eye view of the entire what we call provisions of this particular significant IFRS, or for that is it is 110. We will continue with much more in the upcoming sessions. Hope actually this particular session must have come up to your expectation. I am looking forward to have your feedbacks, quite obviously, especially from students of other what we call countries. If you find that these are worthy, you can continue with this series, and of course students from our countries need to, and in fact they need to actually give their what we call feedbacks. I'm very sure that it must have come up to your likings. One more announcement I would like to actually make here. English version courses are definitely bound to strike, and for that I am going to actually give a separate video later on wherein you will get the entire details, because we are having lots of messages from the student fraternity for the English version courses, especially from the Eastern India side and Southern India side, and those who actually feel more comfortable with this language, correct, whether they are residing in Northern India or for that is any part of India. So we definitely first of all feel very grateful to all of you for what we call showing this much of faith, appreciation, and at the same time trust. So we, on our part, as always, as I say, shall leave no stone unturned in carrying out those trust, those faith, and of course we very much would appreciate your feedbacks too. So on such note, we end up this particular session. As I promised, in the upcoming session there will be lots of more to discuss in this particular chapter. It's a pretty lengthy chapter. So till then, it's a short goodbye from here. It's in fact good night from here in Delhi.